What's up with everybody out there, man? Welcome back to another edition of Sunday School with your boy Buck Bandit P, man. You already know what we do here, man. We here to talk about the money, talk about the cash, talk about the moolah, talk about that chetty, that fatty. You hear me? You already know, man. But before we get into it, you already know what you gotta do. If you here, appreciate you for being here another week. If you ain't tapped into the other episodes, you might want to go tap into the other episodes. It's only 3 right now, so you better tap in now before it get to 33 and 333. Then you're gonna have to go back and watch everything before it start to make sense, because I ain't backtracking. I'm doing everything for the beginners and all that. So when y'all get ready, y'all could go tap into that, and then y'all could just follow along the journey. But before we get started, make sure you like the page. Make sure you subscribe to the channel. Make sure you hit that notification bell so you can see all the videos I drop. And honestly, you don't even got to hit the notification bell, because if you just come here for the finance and I be doing fitness and you ain't into the fitness, you ain't even got to hit the notification bell. But just know that I'm dropping stuff every day, all day for you. So you're going to have plenty of stuff to look at. So let's get right into it. Today, the topic is inflation. I've been posting stuff on the socials all week about inflation, trying to drill this point into people's heads so they can understand how real it is. Hopefully, they will understand how real it is after this one. Hopefully, y'all will, So let's get right into it. What is inflation? We're going to break it right down to bacon bits. What is inflation? Inflation is nothing but prices going up over time. So we all like cheesesteaks, right? Remember back in the day, you used to get a little grub cheesesteak, Poppy stores, you're on $5. You get the fries, you get the chips, you get the soda. It was only a $5 ball, right? Now, how much a cheesesteak costs? You ain't getting no cheesesteaks in the city. I did hear about a spot for $5, so definitely put it in the comments if y'all know where that spot at. But you ain't getting no cheesesteaks for less than $10 now, nowhere in the city. Why is that? Did all of a sudden cheesesteaks just got expensive and just cost $10? It's because of inflation. So let's break it down. It's not like your money just got, it just cost more money and the cheesesteak got more expensive. What happened was your money got watered down. If you go back and look at the videos, I put graphics on my socials, and it shows how that the money get watered down when they print more money. So look at it like this. We got to break it down so everybody can understand it. Look at it like this. You know how when you got juice in a cup and then the little baby can't drink the pure juice, so you dilute it with water, and you still say it's juice, right? That's the same thing. So they just dilute watering the money down, and they saying it's still the same money. But your purchasing power is what's going down, because that same dollar is not going to buy a soda no more. Now that same soda is $1.25. It's not like the soda got more. It's inflation. So now that we understand what inflation is, let's go through the motions. All right. So now we understand that your money isn't just disappearing out of nowhere. It's losing its purchasing power. So why does this matter? It matters because it's a slow leak. So what it is, it's a false sense of security. This is why I say you can't save your way to wealth, and saving money will not save you. Like, it's good. And don't get me wrong. You have to have cash. We already went over that. Go tap into the other videos and see why I'm saying that. But you have to have cash. You always got to have some cash. But too much cash and holding on to it too long is guaranteed you're going to lose on your purchasing power. It's a guarantee if you hold on to it too much for too long. So that's why a lot of the gurus and all that, they say you want to have an emergency fund. It's not you saying you will call them emergencies into your life, but if something go wrong for $1,000, $2,000, you want to have that money readily available. You don't want to have to go transfer and sell some shit and you don't want to do that just for a couple $1,000s. That's why with this investing stuff, we gonna go over it. I'm gonna drop another video, what you should have before you even invest. Like, this is not even for, this is what they say, it's for live men. It's not for freshmen. So if you're a freshman, that's cool. I was a freshman too. I had to figure it out. I'm happy you're here though. We gonna go through it together. But it's some other stuff that you need to get in place before you start investing. So definitely have some cash and have some money saved up. But don't just don't bank on you just having cash, because we're going to go over how inflation is going to eat away at your cash. So Inflation is like we went over. It's prices going up over time. So how do you beat inflation? Well, before we get into how you beat inflation, this is what happens. Every year, inflation gets raised like 2, 3, 4% a year. And every year, people get raises at their jobs, right? But the thing is, you thinking that you getting a raise at your job is going to help you beat inflation, but it's not, because inflation is going to raise about 2, 3, 4% a year. You only going to get about 0.5%, a 1% raise at your job every year. So you still going to be stuck behind that 8 ball. So cash is definitely a depreciating asset, but you always still want to have some. And the example of that is people who retired. I talked about that in my last video. People who retired, it sounds good when you like, all right, bet I'm gonna retire with $250,000 in my retirement. But what you're not realizing, in 20 years when you retire, that $250,000, it's not going to have the same purchasing power that it had $250,000 has today. And that's how you see people thought they could retire and they end up going right back to work, because that nest egg that they thought they was going to be able to retire with is not as much as it looked like 20 years ago, when we add on inflation and taxes and all of this other stuff, because it's a scam. They trying to keep us chasing our tail so we never figure out what's really going on. That's why I'm happy you're here, so we can figure out what's going on, so we at least can have a game plan of how to combat some of the trickery that they got in this system. So keep some cash. You definitely want to have a retirement account, but as we just went over, you don't want to just bank on that, because you're going to be stuck behind the 8 ball. So let's get to the good part. Let's get to the juicy part. We're about 7 minutes in, so I know everybody. So skip the 7 minutes if you're just trying to figure out how to beat inflation. Just skip the 7 minutes. So how do you beat inflation? So this is the thing. You're not going to beat it. You're not going to beat it, but you can outpace it. That's what you want to do. You want to outpace inflation. You don't necessarily want to beat it. Because if you outpace it, because this is what we don't realize. The market go like this. Interest rates going like this. Like, it's always an ebb and a flow. It's never going to stay up here. It's never going to stay down here, because the economy it goes through ebbs and flows. We go through wars. We go through recessions. People lose their jobs. New industries pop up and kill another industry. This is the world we live in. So it's ebbs and flows to the game, but you got to understand how to deal with the ebbs and flows. So how do you outpace it? You invest. You don't just save. You save to invest. And that's not it. That's not the only thing you do. You don't just think, oh, I'm just going to invest and invest and invest. No, what if the market go down for you in a recession for 2, 3 years? Now what? You just invested in it. No, you gotta CYA. We went over that. Cover your ass. The second thing you want to do, you want to own assets. You want to own assets, not just income. And this is the key. Most people think, oh, if I could own assets, then I don't need an income. No, not just income. One of the keys to wealth is several streams. You gotta have several streams. So just because you have assets, don't negate not having an income also, because an income is very valuable to building your wealth. So you want to own assets. What are assets? That is something that can grow and that generates money. So that is houses, that is stocks, that is business. I mean, you can add crypto options, all that in there, but that's more of assets, something that you can hold on to that's going to grow in value over time. And it'll grow in value. It'll outpace what inflation does every year. And that's the key. So you want to invest. You invest in the market. You want to own some assets, and you also want to start early. I don't know how much I gotta talk about starting early. Start where you at. I don't care how much it is, because trust me, you're gonna thank me later. Start as early as possible, because time is your best weapon against inflation. I'm gonna say it again. Time is your best weapon against inflation, because the longer you're invested in it, that inflation is not going to come close to that compound interest. Go back and watch the video on that. So, and the last thing I want to talk about how you beat inflation or how you outpace it. Lifestyle creep, man. We got to talk about lifestyle inflation. Some people call it lifestyle creep. For the sake of this Sunday school episode, I'm calling it lifestyle inflation. Don't inflate your lifestyle because you got a raise. You just came up on some money you wasn't expecting. Listen, that's why you here, and that's why you listening to this. So you can be like, oh, this money I wasn't expecting. All right, bet now this money I could put to work. I can split this up, put half of this in my saving, and I can start my investing account. Because just because you don't got 2-3 months or a couple $1,000s saved up, but you got a couple $100s saved up, throw some money in the market. You disciplining yourself. It ain't about how much you starting with. It's just matter that you starting and you gonna stay disciplined. Like I was putting $5 in the market just because I'm like, I gotta get used to it. And now when I don't put money in the market, I feel, oh, I'm losing money somehow. Because you gotta make it a habit. It's like going to the gym. That's why fitness is one of my things too. Because it's a repetitious thing. It's a consistent thing. And the more consistent you do it, the compound interest is not gonna come close. It's not gonna come close to if you wait longer and try to put more in and go harder and intensity does not beat consistency. I'm gonna say it again. Intensity does not compete with consistency. So you have to be consistent. Don't think you're just going to put a bunch of money in real later and you're going to catch up. No, you're not going to catch up to somebody who already had a 10-year start, no matter what they was putting in, because they was doing it consistently. So that's the episode, man. That's the episode on inflation. Appreciate y'all for being here, man. So happy y'all rocking with me, man. We got another episode coming. Make sure y'all tapped into the Buck Bandit Podcast Network too, and tapped into that Buck Bandit Podcast because it's running up over there. And make sure y'all tapped into that financial corner over there too, because we got some stuff over there too. So make sure y'all tapped into your boy. Follow me on IG, and you already know what it is, man. Let's go out here and get this money.